Scotty, investor interest in small cap stocks has staged a comeback, but there's a major problem here. 40% of the companies in the small cap Russell 1000 are unprofitable. Now, how do you invest with profitable small caps? Let's talk with Paul Baiocchi. He's the chief ETF strategist for ALPS, who manages the ALPS O Shares U.S. Small Cap Quality Dividend. That's OUSM is the symbol. Paul, you heard me, 40% of the Russell's unprofitable. So how do you weed out those unprofitable companies?
Well, thanks for having me, Bob. First of all, it's great to be here. I think at a high level, most investors are just resigned to the fact that they have to have unprofitable companies in their small cap allocation because as part of an asset allocation framework, small caps have been additive from a risk reward and diversification perspective. But by simply screening for things like return on assets, net debt to EBITDA, and then on the dividend side, looking for companies who are not only growing their dividends, but also have well-covered dividends, you can take that universe, Russell 2000, S&P 600, whatever you want to measure small caps by, and cull it down to a list of companies that have the characteristics that avoid drawdowns when you see those sort of violent sell-offs in small caps, as we saw recently off of that massive rally, and ultimately provides a differentiated exposure, a core small cap allocation that is in many ways insulated from some of the worst components. You talked about the 40% or so of Russell companies that are unprofitable, but there's also 9–10% of that index in regional banks, which has been a problem area of the market, as you know.
Right. So does the fact that OUSM weeds out unprofitable companies from Russell lead to outperformance over the Russell? Is that a major factor? It's taking out unprofitable companies. Will that increase performance?
Well, historically, the relative performance to the Russell 2000 has been really strong. And I would say the drawdown avoidance story with OUSM is really the core of what it's trying to do. It's trying to avoid those significant drawdowns. You go back to COVID, Russell 2000, S&P 600, violent sell-off, violent rally. OUSM doesn't typically have full leverage to those rip-your-face-off rallies in small caps, but it also historically hasn't participated fully in those drawdowns that you get in that segment of the market. So I don't want to make any predictions about outperformance over time, but what it's exhibited over time is risk-adjusted outperformance, which is really where this portfolio's bread is buttered, if you will, in the sense that...
So let me move on, Paul, because we got to get going. With interest rates declining, I want to ask you about dividend-paying stocks and ETFs, because you're getting traction here as well. I see inflows here. You manage ALPS O Shares Quality Dividend ETF. You screen for high quality, high dividend yield. I see companies like Microsoft here, JP Morgan, Broadcom, and Verizon. What are we looking for here? And is dividends going to outperform the S&P 500 anytime soon?
Well, Bob, as you know, the challenge with dividend strategies in over the course of the past couple of years has been you typically introduce a lot of leverage to the portfolio from the perspective of balance sheets when you have a dividend-oriented strategy, and those are the companies that have been punished. But as we embark upon what many widely expect to be a Fed easing cycle, the expectations are that perhaps investors will be looking to move out of money market funds into dividend-paying equities, and to the extent that we do see additional inflows into the dividend strategy, those companies that have high leverage typically benefit from falling interest rates, at least have historically.
All right, Paul, we're going to have a lot more about this. We're going to talk much more on how to invest in small caps and dividend payers. That's coming up on ETF Edge at 1:15 p.m. Eastern Time. Paul will be joined by Mike Akins at ETF Action, who will look at what's leading across the broader U.S. style and size landscape. ETFedge.cnbc.com. Scott, back to you.